Hi guys, welcome back to my channel Why Invest, where I'll be discussing latest news, tools and learnings, all but with one aim in mind, to be a great investor. So in this video, I'm going to be focusing on Didi and the headlines it has been making this week, if you have seen it. Well, if you're an investment or stock market enthusiast, you definitely would have. So let's understand why the buzz and what's the fuss. So about Didi, name of the company is Didi Chuxing Tech Co, founded in June 2012, headquartered in China. Key technologies include artificial intelligence, machine learning, autonomous vehicles. Services include public transportation, taxi and limousine services. Valuation. Its IPO in the US valuated the company at 68 billion. IPO in US was offered for 4.4 billion. The top investors are Temasek Holdings, China Life Insurance, Toyota, and SoftBank. So let's look at the timeline, right, from 2012 to 2020. So founded in 2012 by Sheng Wei, a former sales manager at Alibaba, who started an online service allowing people to book taxis through their smartphones. The company, backed by Tencent, was primarily competing in the market against Alibaba-backed Kuaidi. So both Didi and Kuaidi wanted to dominate the Chinese market, and they did so by offering subsidies to the drivers and heavy discounts to customers. Now in 2013, Kuaidi reveals that it got a funding of 100 million backed by Alibaba and affiliates. In the following year, in 2014, Didi reveals that it's got a backing of 100 million from Tencent and others. 2014 is an important year because Uber also entered the Chinese market. Obviously, China, being the most popular country in the world, is a very lucrative market for Uber. And it entered the Chinese market and rolled out its Uber X service in Shanghai and other cities. Now, something else happened in 2015 that's ruined Uber's chances in China. What was that? It was a merger. So Tencent backed Didi and Alibaba backed Kuaidi announced a 6 billion merger, and they rebranded the company name as Didi Chuxing, the company that we now know of. So obviously when your two big market leaders club their sources and their assets, it doesn't leave a lot of room for you to succeed, does it? Or maybe it does, but not so much for Uber. So Uber could not catch up with Didi and ended up losing a significant amount of money. So in 2016, they did the most sensible thing they could. They sold their China stake to Didi, and thereby giving them a 12.8% stake in Didi. This was in 2016. In 2017, Didi raises a 5.5 billion, valuing it at 50 billion. Now, this is really interesting. In 2014, they get 100 million funding, and in a span of 3 years, they have been able to raise 5.5 billion. That's crazy, isn't it? Now, in 2018, this was the year that there were the first initial talks about launching an IPO, and it was valuated at 80 billion at that point of time. Right. In 2019, there were two major developments. One was the overseas growth and the rethinking of strategy. So besides China, the company has also expanded overseas since 2018. First, they entered Brazil by acquiring the homegrown ride-hailing app that was 99 Taxis, followed by its entry to Mexico. Didi at the end of 2019 had presence in around 14 countries outside of China. Didi also launched its services in Chile and Colombia, expanding its Latin American presence beyond Brazil and Mexico. Saudi Arabia, UAE, Europe, and Russia were also being looked at. Didi was already operational in Australia, New Zealand, and Japan. But obviously, compared to the lot, Latin America was a more lucrative market to enter. So in China, they retracted and bring back their food delivery service simply because they lost a significant amount of money as China already had a market leader in that segment. However, in Brazil, they plan to expand their food delivery service as their experts estimated a million orders a day, which again is very lucrative. In terms of rethinking of strategy, Didi decided to rely more on its carpooling services as they believed they had the technical ability which their competitors lacked, technical ability of real time carpooling routes. Then comes 2020, the pandemic year. And look at this is interesting. Didi earned a profit of more than 1 billion. It's crazy, isn't it? Uber had been losing money, especially in the pandemic year, because of the pandemic driven lockdowns. But Didi managed to make a profit of 1 billion. I was quite surprised and taken aback by it. But then, to put matters in perspective, China was one of the first countries to recover. In fact, I think even till date, China is the only country that has recovered from the pandemic and has come out uh, and still has a very stable economy. So I think it goes without saying, since Didi's largest market is in China, I think this figure is believable. Whereas in terms of Uber, all the countries where Uber has a significant market share were in major lockdowns throughout the year. So it's only understandable that Uber suffered severe losses. So that's the timeline of Didi from 2012 to 2020. So now we come to the financials piece. Now this is Didi is the second largest Chinese IPO being offered in the American market. So I obviously got curious to understand how the company functions and how it has performed over the previous quarter for such a huge IPO being offered in the US. So here is a glimpse of its financials. I've pulled out this data from Google Screener for quarter one of 2021 for Didi, listed in New York Stock Exchange, Uber in the same stock exchange, and Lyft in NASDAQ for a more apples to apples comparison as to how Didi is performing vis-a-vis its competitors in the US. So in terms of revenue, it's 42.16 billion, while Uber is at 2.9 billion and Lyft is 609 million. Net income is 5.48 billion for Didi. It's negative for both Uber and for Lyft. Net profit margin. Now this is where it's interesting. You can actually glimpse through and look at all of the other figures, or more or less is it kind of sizes up. You can size up these companies vis-a-vis Uber and Lyft as well. But the net profit margin is where I see a concern. So pre-pandemic in 2019, they were at minus 2%. And this has come to minus 13%, right? And in 2020, if you remember in the previous section, I mentioned in the earlier part of the video that they had a profit of 1 billion. Despite that, in quarter one, they're at minus 13%. Now, this is a bit concerning. So initially, Didi was looking at a valuation of 100 billion when they were going for the IPO in the US. So had it been valuated at 100 billion, it would have compensated for the losses that they were bringing in. Right? So it would have put them in a very good position. Although I personally feel the 68 billion valuation is really just looking at these financials, right? And I also have a concern that if they do not improve on their profitability piece, somehow manage probably the subsidies or the discounts that they've been giving out, somehow build into their profitability a profitability margin. If they don't improve on it, then there is a concern, because no matter how much money is being pumped in, at some point of time they would need another fresh cash flow coming in. So yeah, these are the financials of Didi for you to look a glimpse. So let's have a quick review. So yeah, prior to its listing, Didi was rumored to be valuated at 100 billion. It's currently the market leader in China and has some presence in Latin America. Fire estimate predicts tremendous growth. So in China alone, they expected a growth of 30% per annum. And growth is expected obviously across the globe and mainly in Latin America, which is the primary market that Didi is looking into. So yes, this concludes the financials piece for Didi. Next, let's understand why go public in the US. You're a Chinese company, why wouldn't you choose Hong Kong and why go to the US to go public? So, many Chinese tech startups, especially the ones which aren't making profits, right? And when they want to raise capital in foreign currencies, they've generally preferred US over Hong Kong. And there is a reason why. So in Hong Kong, companies either have to generate an aggregate net profit of at least 30 million Hong Kong dollars, which is approximately 3.9 million USD, over the 2 preceding years, or have a market capitalization of Hong Kong dollars of 2 billion at the time of listing, and revenue of at least 500 million Hong Kong dollars to qualify for the Hong Kong Stock Exchange main board, right? And in comparison, the US market in New York Stock Exchange rules require companies to have a much smaller market capitalization threshold of about 200 million USD, which approximates to 1.5 billion Hong Kong dollars as compared to its 2 billion in Hong Kong, or an adjusted pre-tax profit of 2 million USD in the past 2 years, rather than a net profit. It's a pre-tax profit, not the net profit, right? Also, US market is the deepest and the most liquid in the world. Third reason could be the more capital funding opportunities. Also, you're able to tap into the reservoir of American investors who generally have an appetite for Chinese tech companies, right? And finally, avoidance of Chinese regulations. Now, that's the reason why it's highlighted here, because that is essentially the premise of this video. So to avoid these Chinese regulations as well, there are some companies that prefer to go public in the US as compared to Hong Kong. Right? Also, it needs to mention here companies like Alibaba Group Holding, JD.com, and Baidu opted for the less stringent listing requirements offered by the US and returned to Hong Kong with secondary listings in the past 2 years, following reforms by the city's board. So basically, they first went in the US, got the financials and the requirements at par with those of Hong Kong, and then they come back and then list in Hong Kong. And this path was what Didi was planning to take as well, right? So that summarizes why go public in US. Next, let's look at the incident. Weekend of July 2021, Cyberspace Administration of China announced a cybersecurity review of Didi's operations. 2 days after launching its probe against Didi and banning new downloads of the company's app, the administration cited the need to prevent data security risks and safeguard national security. China ordered its app stores to remove Didi Chuxing, citing serious violations on the company's collection and usage of personal information. So here's what's believed to be the reason why. Soon after the probe against Didi was announced, Chinese social media users began circulating screenshots of a 2015 study. So when using playful charts, the study was used to show the movement of traffic at the Ministry of Public Security. So this in turn is an obvious red alert for the regulators, as this data can be quite easily used to track the travel habits of government officials. Now, this, from China's standpoint, can well be used as a source of valuable intelligence in the hands of foreign spies. Also, do know that Alibaba, on the other hand, when it went on for an IPO in US, faced challenges as well, and they were fined 2.8 billion for anti-competitive practices. But there was no such ban implicated on them. So Ant Group's IPO was scuttled because of concerns about its lending, and the investigation launched in April against Meituan was an antitrust probe. So national security wasn't a concern there, right? And it's not just Beijing that's waking up to how sensitive data can be. Washington is right now conducting a review of services such as TikTok and WeChat to determine what they exposed about American citizens to the Chinese government. So it's sort of a tug of war between the two economies, US and China, but control on big data, in other words. So as of July 7th, the ride hailing company fell 4.6% in New York trading to close at 11.91. You can see in this screenshot that I've taken, it was at 15. It was started somewhere close to 15 on Thursday. By Wednesday, they were at 11.93. A big dip, right? So that was, in short, what the incident was about. I've kept like a small one-liner here. Data security or a narrative to control big data. Chinese IPOs come with a disclaimer now. This is clear as day for all American investors who are looking to invest in Chinese tech companies henceforth. Next, let's look at the aftermath. So in China, regulators are planning rule changes that would allow them to block a Chinese company from listing overseas. This mainly is due to their concern over data security and their need to increase the regulatory oversight of these companies. China also is moving to encouraging local tech listings. This is simply to ensure that data is restricted within their national borders and hence is in safe hands. Besides this, there are two other initiatives that China's regulatory body is looking into. One is separating the financial products from payment services, and the other one is limit investment in banks and insurance firms. So all of these proposed changes could also impact companies that have already gone public using the so-called variable interest entity model. Meanwhile, in USA, there were two shareholder lawsuits filed, one in Los Angeles and one in New York, which was obviously expected. And the basis for this lawsuit was there are reports wherein it stated that the Chinese regulatory bodies had informed Didi and had expressed its concern over its data collection and usage, thereby asking them to delay their IPO. But Didi, for some reason, chose to ignore those alerts and went ahead with the IPO anyway. So obviously this has gotten a lot of the American investors seething, and they have filed lawsuits against the company. Also, Didi lost 1.5 billion in wealth over 2 trading days. So if you can look at the chart in the bottom left corner, this is a Bloomberg graph that shows a 1-day price drop of the Chinese companies listed in the US. So you can see Pop Culture Group, the price dropped by 35% in a day. Didi Global by 20%, Full Truck Alliance by 15%, and so on and so forth. Now to summarize, I know Didi has been the talk of the week and it has made the headlines this week, but it needs to be noted that the net income statement or the balance sheet of the company is still going to be unaffected by this incident, simply because millions of users still have access to the app. Do understand this ban is for all of those users who'd want to download the app after the first weekend of July 2021, right? Not for the ones who already have it downloaded in their phones, in their smartphones, or in their devices. So there are people in China who are availing the services of Didi unhindered. Also, it goes without saying that a company as big as Didi wouldn't really be sitting down on this ban. They would try to work out a timeline, fix the issues, the loopholes or the issues that the regulatory body have with its data collection or data usage policy, and very soon the ban could be lifted. Now, how quickly Didi bounces back would also depend on the investor sentiment. So, to summarize, I think for the sake of American investors and investors across the globe who invested in Didi, I really hope that Didi bounces back soon, which I think it will. So yeah, this was my video on Didi, and I hope you liked it. Do let me know if you want me to cover some other investment topics. I will do so. Until then, stay safe, take care, bye.